Debt restructuring plan for COVID hit companies is out. KV Kamath report lays out 5 parameters across 26 sectors as a blueprint for resolution. Metros back in action in 6 cities, even as there is no respite in India's COVID tally. We've crossed Brazil. Tonight we ask whether a chalta hai attitude has crept in towards COVID. What's in a name, they say? Well, Vodafone and Idea hope their new brand V will revive their fortunes. Rebranding exercise comes ahead of fundraise. Former ICICI Bank Chief Chanda Kocher's husband, Deepak Kocher, arrested by the Enforcement Directorate in the ICICI Videocon case. Centre provides why security arrangements to actress Kangana Ranaut when she is supposed to arrive in Mumbai. Sparks of political fight. Maharashtra government led by Shiv Sena fumes and calls the move political. Very good evening and welcome to the India Development Debate. I'm Tamanna Inamdar, and what a news-packed evening it has been. Well, first up, the big story that everyone's been waiting for. The KV Kamath Committee recommendations are out. So here's what had happened. In the last monetary policy, the Reserve Bank of India had deputed the KV Kamath Committee, so a committee led by top banker KV Kamath, to come out with a set of guidelines for companies that have been hit specifically by COVID-19. This included giving these companies a 2-year period or a moratorium of sort, or an option to restructure their loans so that they don't slide into an NPA. The banking sector doesn't get saddled with a huge amount of debt. And there is a chance for these companies to survive within the banking framework. So now, today, those guidelines are out. That list is out. First up on the show, we're going to talk about what exactly those guidelines say, what they mean. Mythili Bhusnurmath, consulting editor, ET Now, and Alok Dhir, managing partner, Dhir Dhir Associates, is joining me on the show. Welcome to both of you, and thank you so much for speaking with us. Mythili, so 5 parameters, various ratios that the committee has laid out and the RBI has accepted. Broadly speaking, for example, they do a total outside liabilities by adjusted tangible net worth, total debt, by EBITDA, current ratio, which is current assets versus current liabilities. So there is a whole set of ratios meant to ascertain whether a business has the capability of being a going concern even after 2 years of a restructuring. To your mind, Mythili, from what you've seen of all the guidelines, do you think this is going to be sufficient to help and save companies which have been hit by COVID?
Well, Tamanna, the committee has done its job, which it was asked to do, which was to define the various ratios for different sectors. So it has done them for 26. So that part of the job the committee has done. But will this really materially help in providing succor to the borrowers and to the sectors that really need help? The answer to that is no. Because frankly, I think the entire process of what we've gone through, both in the RBI's resolution guidelines and as a result of the Kamath Committee submitting those ratios, is that we made the entire lending exercise a somewhat mechanistic ticking of the boxes, rather than what it should be, a commercial decision, a financial decision, which always involves an element of risk. You raise the question of whether 2 years down the line, whether companies would be in fighting fit. Well, that's an answer to which perhaps even God doesn't have an answer today, because nobody really knows. The level of uncertainty is so much. So I think what was missing in the entire process is the RBI has not given banks the flexibility and the agility that it needs in these times, and quick response time with very minimal bureaucratic processes is what is required. Whereas what we have now is that we have a committee which will go into which has gone in and given a report, submitted various ratios. Then you'll have to work out a resolution plan. The resolution plan in the case of large accounts over 1,500 crores has to be vetted by the committee. Then if it's over 100 crores, you have an independent credit rating agency. So the whole exercise of lending, which should be a quick response action by bankers, has now been reduced to a somewhat bureaucratic ticking of the boxes exercise. So I doubt if it will really help. What it will do in the process, it will give bankers an excuse and it will give them some kind of protection where these ratios are met. But will this necessarily mean that you won't have NPAs 2 years down the line? I'm sorry, the answer to that is no.
Well, perhaps the can has been kicked down the road, but one end of the spectrum was to protect balance sheets of banks and give them also a way out. The other end, of course, is to make sure that some of these companies survive. I mean, you look at what the committee says, and they put out a snapshot actually in their report of how sectors have been hit and how industry has been hit by COVID-19. As per the sectors that they have surveyed, 72% of them were affected by COVID. Mr. Dhir, I just want to get your take on how this really helps. I mean, the key differentiator is here, the owners hang on to their companies. It's not like resolution processes under IBC where they may lose control. Here they hang on to their companies, they have a lifeline, they have a chance. Do you think that there is too much left to the discretion of the banks, or is there enough to ease any anxiety and make sure that they lend and allow a lifeline to these companies?
My take on this issue is that the government has set up this committee, a 5-member committee, and obviously they are bankers of great repute. The purpose for the committee is to recommend the list of the financial parameters to be considered for the restructuring of the loans impacted by COVID, the COVID-induced stress. Now, all the resolution plans which are given from time to time when companies are in stress are based on certain parameters, financial parameters, which have to be looked at by the bank. These parameters are to be looked at the stage of lending. They are looked at the stage of monitoring, and at the stage of restructuring also they are looked at, and the parameters then determine whether the plan is viable or not. That's the principal reason. Now the committee was asked to look at these 5 parameters with the intent and analyzing the impact of COVID on these 26 industries as to what should be the approach to be adopted by the banks when looking at the resolution plans. The intent was to give a direction. The intent was to give a sort of a relaxation to the banks to consider. Now, look at the ratios and look at the analysis. In fact, a very delicate, if I may say, a very intense and a very delicate approach has been adopted, so that sector after sector they have looked at and realized that what are the implications which each of these sectors are facing. I mean, let me just say, for example, insofar as the aviation sector is concerned, the current ratio has been taken as 0.40, whereas auto components, the current ratio is 1. And most of the sectors, it is taken as 1, but one sector which has been highlighted, which is aviation, they have taken the current ratio as 4. So they have looked at the sector and realized that in this particular sector, there is a lot of bookings which are made, cash in hand becomes higher. So the current ratios have been fine-tuned. And similarly, if you see the total outstanding liability versus adjusted tangible net worth, it ranges from somewhere in the region of 10 to somewhere in the region of 3. That means for each of these sectors, they've analyzed what are the financials of these sectors, how these sectors, the asset build-up, the tangible net worth.
Why don't you explain this portion to us?
Come again?
Yes. Yes, in fact, what you're talking about. So, why don't you explain the, what this means? So, auto components, for example, the TOL, by ATNW that you were just talking about, tangible assets, that for auto components it's at 4.5, while for real estate, residential is at 7, commercial it's at 10. So, what does that mean? Has the committee in its wisdom, found that the real estate sector is more vulnerable, and hence these ratios have been allocated? What is the takeaway from the way these ratios have been allocated to these sectors?
See, there is no explanation which has been given along with the report, nor is the RBI's notification, which is September 7, 2020, giving a detailed analysis of why these ratios have been adopted. But by a reading of these ratios, if you look at, because there were 5 ratios, which they were 5 financial parameters which they were giving, and these are the 5 critical financial parameters for looking at viability of any project. Now, in each of these, if you see, and that's what I'm trying to point out without going into the details as to why each one of them has been taken as is, in each sector they have analyzed. Now, when you look at all of these, you look at first thing, TOL versus ATNW, which is the total outstanding liability versus the adjusted tangible net worth. So what happens is that the adjustable attainable net worth and the total outside liabilities, which means that if I have a net worth, let's say for auto component sector 1, then about 4.5 times that is the total outside liability, which I can retain for the purpose of viability. Now, this has gone in the aviation sector at 6, because in the aviation sector, the net worth of 1 can sustain total outside liabilities of 6. It goes on to real estate. In real estate, they are saying that the total outside liabilities versus adjusted tangible net worth is 7 for residential and 10 for commercial. It reflects to my mind that each sector has been analyzed in great detail, and they have tried to analyze to what extent is a multiple of the net worth that the liabilities can be sustained on a viable basis by each of these sectors. Similarly, when you look at the total debt versus EBITDA, here also you are seeing the variation is from somewhere at 4x to 12x, which means that if there is an EBITDA, that is the earning before interest, tax and depreciation, if there is a figure of EBITDA, then what is the total debt that it can sustain in each of these sectors? And you can see the variation is writ large from somewhere in the region of 4 to 12. Current ratio, which is typically taken as 1 as a reasonable mechanism while evaluating projects for lending, has been brought down to, which is typically taken as 2, is brought down to 1, which means that those entities, and especially these entities which are COVID hit, are unlikely to have substantive current ratios. They've brought it down to 1. That means 1 rupee that I have in my hand, I can sustain current liabilities to the extent of 1. Typically, we do 2:1 because we want to have more cash with us so that we can sustain the liabilities easily. Average DSCR is brought down to 1.2. DSCR is 1. Typically, we take 1.33 as an average DSCR. So one can see from these parameters that the committee has been trying to do a very great fine-tuning to work to a number which will be viable in the current environment and at the same time give the relaxation to the industry so that the industry is able to sustain. They will not be able to sustain the financial parameters which were applicable in the pre-COVID environment. And at the same time, if the banks were to apply the financial parameters and the tools which they have been applying at the stage of lending and monitoring of the projects, if they start applying the same parameters, none of these will be viable at all. So there will be no restructuring, no resolution plans will come. And at the same time, they have given some level of flexibility to the banks when they see the resolution plans. If some parameters are not defined or if a variation has to be made to these parameters, then the banks have to look at the resolution plans and analyze and take a decision. Perhaps the entire purpose was this, to put together a minimal level of financial parameters which are to be considered for evaluation of the resolution plans or the restructuring plans, if I may say so, for giving the approval of the restructuring plans. And the bank should not be handicapped by trying to apply very strict, harsher parameters which are applicable in the normal environment to the current situation.
No, absolutely. Look, there was no doubt that we needed, a different approach for COVID hit companies. Mythili, my question is one that has remained to some extent. Is there enough clarity on how you will determine if a company has been hit by COVID or was already sinking? I know there is a March 31st cutoff. In terms of a account being standard with a 30-day sort of leeway. But is that sufficient to analyze the extent of hit because of COVID? I mean, we've seen example after example of companies that seemed like they were doing okay or could have survived, but COVID pummeled them.
Of discretion is so it's very difficult to exactly quantify. And as Alok mentioned, these are threshold ratios. So while it is good that the Kamath committee has gone in and has come up to the entire issue and gone into different sectors and come out with certain threshold ratios and said these are minimum threshold ratios, and broadly it has kept in mind the philosophy that the sectors that are hard hit, there the ratios are a little more generous than otherwise. But the fact is, Tamanna, that in banking there is a term, in good faith and without negligence. An action taken by a banker, and we're not talking about small accounts, these are all large accounts that we're talking about. So when you have, and typically you'll have a consortia of bankers, that means more than one bank. So when all these bankers act together in good faith and without negligence, then I think what is necessary for them is to have the confidence in their own lending ability, because this is what they've been doing all their life. A banker is in the business of taking money from depositors and lending, and there's always an element of risk. You can never entirely rule out NPAs, non-performing assets. So simply because you abided by these ratios in very mechanistic terms does not necessarily mean that you rule out NPAs. In fact, because I've been in the business, I've been so long in the tooth really, that there was a time in the 80s when the RBI used to do the sanctioning of accounts under what was known as a credit authorization scheme, and then it kind of changed that to credit monitoring authorization scheme. There the RBI was dispensing the credit in terms of giving the sanctions, and there also many accounts went bad. So it is not as if that just because you have certain ratios and specify those ratios you will never have NPAs. So I think the need of the hour really was for agility and allowing banks the nimbleness to kind of go and sanction the resolution. Whereas what you have now done is you've specified certain ratios, and mind you, these ratios can always be conform to inform, but not necessarily in spirit, because accountancy is a profession where the rules are not very hard and fast. There's a great deal of scope to, in fact, where you how do you classify a certain entry. So there is a certain element of possibility, I wouldn't say fudging, but of getting the ratios that are best suited for the borrower. So ultimately, I think unless you tell banks that any action done in good faith without negligence will not be questioned, I think in the process what you're doing, you've made the entire exercise of lending very bureaucratic. And what is needed at the moment is really quick relief. The committee itself says that there have been many months have been taken to come up with resolution plans. So I think in the process, the end result that you were aiming for of giving succor to borrowers who are hard hit, that will not be served with the best of intent, but the ultimate result you're not going to get.
Well, that would be unfortunate. That would be unfortunate because that really is the crux of it all. And let me just take a second to explain why this is so important. If these companies survive, jobs will survive, economic recovery will be faster, we can hope for a brighter situation. So it is imperative that these companies survive, of course, not while sinking the balance sheets of banks. That balance has been attempted to be reached with these recommendations. The devil lies in the implementation, as always. Thank you so much, Mythili and Mr. Dhir, for joining us in the first big story. We'll also play out for you a very quick soundbite from KV Kamath, who is the chairman of this committee. He's, of course, a legendary banker and spoke with ET Now before these guidelines were out, talking about how he was committed to meeting the deadline.
So the panel is working. We're working overtime. We had initially 2 meetings a week. 6th August, and then getting it going took us a few days. This week we will have 3 meetings. Next week we will accelerate it if possible. Somewhere next week we should, before the date, the due date, we will certainly submit the report by working at extra pace as necessary.